The Relative Strength Index, or RSI, is one of the most widely used momentum indicators in technical analysis. As you can see from the graph above, the RSI measures the speed and change of price movements, helping traders determine whether an asset is overbought or oversold. But what are the practical uses of the RSI in trading? Identifying overbought and oversold conditions. One of the primary uses of the RSI is to identify overbought and oversold conditions in the market. As shown in the chart, the RSI scale ranges from 0 to 100. A reading above 70, as highlighted in the graph, typically indicates that an asset is overbought and may be due for a correction or pullback. Conversely, when the RSI drops below 30, it suggests that the asset is oversold, potentially signaling a bounce. For example, if you look at the stock chart above, notice how the RSI moves above 70 before the price starts to pull back, confirming overbought conditions. Similarly, when the RSI dips below 30, you can see a price rebound shortly afterward. However, it's important to use these signals alongside other indicators, as assets can remain overbought or oversold during strong trends. Identifying divergences. The RSI is also excellent for spotting divergences between price action and momentum. If you examine the graph above, you'll notice two types of divergences: bullish and bearish. A bullish divergence occurs when the price forms a lower low, but the RSI forms a higher low, as highlighted in the image above. This signals that downward momentum is weakening and may lead to a potential reversal. On the other hand, a bearish divergence, seen in the top right of the graph, happens when the price makes a higher high, but the RSI fails to confirm by making a lower high, indicating a slowdown in bullish momentum. Identifying trend strength beyond overbought and oversold signals, the RSI can also be used to gauge trend strength. As you can see from the middle section of the graph, during a strong uptrend, the RSI stays above 50, indicating that bullish momentum is intact. Conversely, in a downtrend, the RSI remains below 50, confirming bearish momentum. Traders can also use the RSI for potential trend reversals. For instance, when the RSI crosses above 50, as shown in the graph above, it signals the beginning of an uptrend. When it dips below 50, it can indicate the start of a downtrend. In summary, the RSI is a versatile tool that helps traders identify overbought or oversold conditions, detect divergences, and measure trend strength. As illustrated by the graphs and charts above, mastering this indicator can provide deeper insights into market momentum. However, as with any tool, it's best to combine the RSI with other technical indicators to increase the accuracy of your analysis. So, take a closer look at the charts and graphs you're working with, apply the RSI, and see how it can enhance your trading strategy.